Welcome to Keeping It Real, the weekly live conversation series where we bring you insights and knowledge from real estate experts in Kansas City and beyond. We are your hosts, Samantha Salem
and Mikey Maria,
and we are thrilled to be here with you today.
Our goal is to provide you with valuable information and insights that will help you navigate the real estate market and make informed decisions about buying, selling, and investing in real estate.
Each week, we'll be talking to experts in the real estate industry. We'll be diving deep into the latest trends, strategies, and best practices that are shaping the Kansas City real estate landscape. We're here to keep it real, and we're excited to share our conversations with you. So sit back, relax, and let's get started. Welcome everybody to our very first episode of our new education series. It's called Keeping It Real, where we talk about all the things regarding real estate, whether it's home buying, whether it's investing, whether it's credit scores, whatever it is, we want to dive in deep on one topic every episode and bring in our experts that can answer all of our questions for us. So today's expert is Mr. Carmine Difulvio. He is a tax exchange expert from Security First Exchange, and he's here to tell us a little bit more about what is a 1031 exchange and why do people do it and what are the pros and cons of using them. So, Mr. Carmine, welcome.
Thank you so much.
Glad to have you here with us. So, I heard that you are the expert on this.
Well, there are a lot of us out there, but I've been doing this for a long time. I'm the director of Security First Exchange. I've been doing exchanges for 22 years. So I've got a little bit of experience, over 19,000 exchanges. So if people have questions, I can definitely help them out. I also have a designation called the CES designation. In our industry, you can earn this Certified Exchange Specialist designation, which would be similar like to a CCIM designation for commercial realtors. We go through education, testing process, and then we pass the test and we get the designation. There are about 130 of us in the country, so not that many. So I'm pretty proud of it because it says that I pay attention to what's going on. I stay up to date because obviously there are changes in tax codes pretty regularly. So we want to stay informed on that.
Absolutely. 130 in the whole states, that's like less than 3 people per state.
Yeah. Well, in some states, none. You know, in California, Texas, Florida, maybe a couple more, but through the Midwest, there are not many CES designees. You know, North Dakota, South Dakota, yeah, we just don't see them. So we're, like I said, it's a pretty small group.
Okay, well, that's awesome. Well, I am glad that you're here with us today. So we're excited to see what you have to share with us.
All right. Well, let me go ahead and get that screen shared for everybody. Share. There we go. Have we got that looking good for everybody?
I can see it.
Wonderful. So we're going to talk about some pros and cons today on 1031. You know, what's the benefit? What are the challenges, obviously? You can see all of my contact information there. If you want my email address or my phone number, if you screenshot that QR code, that's all of my contact information, but it's also in the slides as well. So I'll just pause there for a second, let everybody grab that, and then let's go ahead and move on. So what we're going to talk about a little bit, there we go. We're going to give an overview on 1031 exchange. We're going to talk about what taxes are deferred by doing a 1031. So why are you doing it in the first place? We'll talk about like kind, because there's a lot of confusion with people on what you can buy and sell through a 1031 exchange. We'll talk about that. We'll talk about the financial requirements. There are specific requirements that you have to meet to be able to defer your taxes. And then lastly, we're going to talk about the time frames and the identification rules. That's where it gets a little hard, a little tricky to be able to complete the exchange. And I'll try to give you some ideas about that as well. So, and for those of you that are watching on Facebook, if you do have questions, you can go ahead and enter them, and then we'll be able to answer those. We'll take a couple of short breaks as we go through, and then at the end, we'll try to cover all those questions for you as well. Some people don't like to ask those questions publicly, but like I said, if you don't want to, then obviously you can email me directly, and then we can answer those questions too. All right. So let's jump in. People don't think that 1031s are popular. People think it's only for commercial property. There aren't that many happening. There are a lot of exchange happening. Now, just numbers around Kansas and Missouri. Here are some stats. This is the percentage of rental properties in various areas in the states. Now, we get this information directly from the IRS because when you own an investment property, a rental house, you have to report that on your tax return. So the IRS knows how many rentals there are. And this public information, you can actually get this from an IRS website. So, as you can see, Kansas City, Missouri, 45.9% of single family residences are rentals. It's a huge number. Now, these numbers are specifically under RESPA. So these are single family residences, 1 to 4 units. That's the only properties that qualify under RESPA. So we're not talking about a 6-plex or an 8-unit property. This is specifically 1 to 4. So you can see there are a good number of investment properties out there. So we've got a lot of people doing 1031 exchanges. Nationally, up around between 80 and 85% of 1031 exchanges are on houses. It's not commercial property or land. It's a house or a 1 to 4 unit property. So don't think this is only for big commercial properties. No, we're dealing with regular investors all the time. A mom and pop that own one rental house and they want to do an exchange because they don't want to have to pay that tax that's due. So we deal with those types of clients regularly. That's the bread and butter, shall we say. Now, when we talk about 1031 exchange, I'm not going to read the whole code for you, which was written back in 1921, so over 100 years ago. But the bulk of the code, the meat of the code, is this one paragraph. And it says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which to be held either for productive use in a trade or business or for investment. What does that mean? It means you sell an investment property, you buy an investment property, you can do a 1031 exchange. It's as simple as that. People get a little confused, but like I said, the benefit and the reason you want to talk and listen to some guy talking about 1031s is because you're going to save money. You're not going to have to pay the taxes when you sell that property. So what taxes are deferred by doing a 1031 exchange? Well, first we need to understand how a capital gain is figured out. Now, I'm going to overgeneralize today just for our purposes. To figure out a capital gain for if you were selling a property or you have a client selling a property, you need to talk with the tax person. They're the only ones that can be specific. But I'm going to give a general idea just for our conversation. The way you figure out a capital gain, you take the sales price of the property and subtract the cost. That's your profit. That's your capital gain. So, for example, if I'm selling $1 million property and I bought it for $500,000, I'm going to have $500,000 gain, profit. That's what I'm going to pay tax on. So what am I going to pay on that? Well, the first tax I'm going to pay is capital gains, is the federal capital gain, excuse me. That capital gain is calculated on either a short-term or a long-term basis. If you've owned the property for less than a year, it's a short-term gain. And then that profit is taxed as income. So let's just say you have a client that makes $200,000 in a year, and they sell this property that they've owned for 6 months where they make $500,000 on it. That's a short-term gain. They would tack the $500,000 onto their $200,000 income. So that means this year they're going to make $700,000. That's going to be their tax liability. And obviously that would put them in the highest tax bracket. Now, if it's a long-term gain, meaning they've owned it for a year and a day or longer, they would pay 15% on the profit. If they're single and they make under $492,000 adjusted gross income, or if they're married and they make under $553,000. If they're under that level, they pay 15% on that $500,000 at $500,000 profit. If they make over that amount, they pay 20%. So most taxpayers are going to be in that 15% range. So that's the first tax you don't have to pay if you do a 1031 exchange, the federal capital gain. That's number one. The second tax you don't have to pay is the state capital gain. State capital gains vary across the U.S. 41 states have a state capital gain. Kansas is 5.7, Missouri is a 6. So we just rough and say it's going to be another 6%. So you pay 15% federal, most likely. You pay another 6% to the state. That's 21%. So on $500,000, at 20%, that's $100,000 in tax. Do you want to have to pay that? Or do you want to be able to keep that money and use that money to reinvest in a new property? That's what 1031 allows. It allows you to retain wealth and use that money to buy something else. But I'm not done. There's more taxes. The third tax you would defer when you do a 1031 exchange is called the 3.8% net investment income tax. What that is, that started in 2013 from the Affordable Care Act. They had to pay for it someplace. So some people don't have to pay this tax. It only affects high earners. Well, who are high earners that have to pay this tax? If you're single and you have an adjusted gross income over 200,000 in a year, or if you're married and you have an adjusted gross income over 250, you have to pay this extra 3.8%. So if you do fall into that category, you're looking at 15% minimum federal, another, again, 6% state, and now we've got another 4% here roughly. So now, no, excuse me, you're now at 25%. So 25% of your profit is being paid in taxes. So now again, $500,000, that's $125,000.
That's a lot of money.
Crazy. I'm still not done. There's one more.
Oh my goodness.
Yeah, it keeps on going. The recapture of depreciation. When you own investment property, you really own two things. You own the land and you own the building on the land. Well, the building on the land is worth less every year. So you get to take depreciation on it, a tax write-off. But here's the catch. Let's say you own a $300,000 house. You're probably depreciating it somewhere in the neighborhood of $5,000 a year. Let's say you own it for 10 years. That's $5,000 a year, 10 years. You depreciated at $50,000. When you sell, if you don't do an exchange, you have to pay back 25% of however much you depreciated it. So $50,000, again, 25%, that's another $12,500 in taxes you owe, unless you do a 1031 exchange. Those are the 4 taxes deferred by doing 1031s. And like I said, they're big numbers. So you need to reach out to your tax person or your client that wants to do an exchange to figure out exactly what your number is going to be. But obviously, the bigger that number, the more incentive you have to do a 1031 exchange. Because again, do you want to give up that money? Do you want to give it to the government, or do you want to keep it and use that money to be able to do an exchange and buy other property? It's like an interest-free loan. The government's saying, do an exchange, you don't have to pay the tax, and you pay back later. This is a tax deferral mechanism so that you can pay down the road when you eventually sell and don't do another exchange. But there's one way to get out of paying the taxes ever. It's a bad way, called dying. Dying will get you out of it. So I know I didn't mean to say it's called dying, it's just dying. What it does is there's a term in the tax code called a stepped up basis. So you've been deferring these taxes for the years over and over and over again by doing multiple 1031 exchanges. When you pass away, your heirs inherit the property at this stepped up basis. So their basis is increased to whatever the value is of the property when you passed. So all that tax liability basically gets erased when you pass the property to your heirs. That's the huge benefit of a 1031, is that eventually you can erase that when you pass the property to your kids. I know I've been talking for it feels like an hour already. I'll go ahead and pause for a second, and maybe we'll see if we have any questions that we can bring into the picture.
So let me just recap this really quickly.
Yeah.
I buy an investment property. I want to sell it after 2 years. Any gains that I made, any profit or appreciation from the market, I don't want to pay taxes on it now. So I do a tax exchange, and then I find another property and then just roll all of those dollars into it without having to pay taxes on it now, these 25+% that Uncle Sam is lining his pockets with
Right.
my hard-earned money. So, but it's not free taxes. It's deferred. That means you still have to end up paying it at some point. It's just free for now, I guess.
Right. So if you eventually sell the property and don't do an exchange, you're going to pay the tax then. So if you decide at some point I am going to sell in 20 years, when I retire, I'm going to sell and I'll pay my tax then. The tax doesn't go up. So if you owe 50,000 today, you still owe that 50,000 in 10 years, 20 years. It doesn't go up because of inflation. The IRS doesn't say, well, hey, you've had this money for 20 years. We're going to charge you 3% interest because we want to get our cut. No, you just pay in the extra 50,000 and then whatever gain you had on the property, the new one. So it just keeps on building. But like I said, there is one way to get out of it, not a great way. It's passing.
Well, then other people might have to pay.
Well, no, like I said, the heirs get rid of it. Basically, the tax gets wiped away, and it's pretty common. The stepped up basis is a great tool. So if clients, if anybody on the call is saying, "Wow, that sounds like a great idea," talk to your tax person. Talk to your tax person about how I can get a stepped up basis so that when I pass away, my heirs won't inherit that tax liability. It's very easy. It's very common, but you've got to structure it right. The tax person is the only one that can do that.
And that's how we build generational wealth.
Exactly.
Tax-free. That's hilarious. And another question that I get usually is, can we do a tax exchange on a primary home?
It only works for investment properties. So you cannot do an exchange on your primary residence.
Okay. And can I use tax exchange funds to purchase an owner-occupied property?
Again, no, because when we're going to get to the like kind in just a minute, but actually, let's jump. I'm going to go ahead and jump ahead, and then we'll see if there are any other questions that come up. I think it's a great point. What is like kind? What can I buy and sell with a 1031 exchange? So let's look at it really quick. You can buy and sell any type of real estate. So raw land for single family, multifamily for a retail center, office for warehouse, a fourplex for a tenant common interest in property. It doesn't matter. Any type of real property qualifies for 1031 exchange. It's about the use. The property has to be held for investment purposes. Like when I read the code earlier, it said property held for productive use in a trade or business or for investment. So it can't be a personal use property. So a second home, a primary residence, a vacation home, they don't work. It's got to be investment. It doesn't have to be investment forever though. So I do have clients that say, you know, I'm getting close to retirement. I plan on retiring in a couple of years. So I want to sell the house I have here in Kansas City. And I want to buy a house in Florida, in Boca Raton. I want to retire there. But if I'm doing an exchange, I can't live in it. Well, you can't live in it for now. So what you do, you buy the house in Boca, rent it out for a couple of years, and then later you can convert it to personal use property. There's nothing wrong with that. The code doesn't say how long you have to hold the property as investment, but most tax professionals say a minimum of 2 years. So rent the house out for 2 years and then retire to it, and you move into it, and there's no tax due because you didn't sell it. The tax is going to be due when you do sell, but if it's your retirement home, it's probably going to be your last home. Then you pass the property to kids when you pass away, and then you erase the tax.
Interesting. So at the end, let's say I buy the property. After 2 years, I move into it. I live in it for 5 years. Now it's my only property that I live in. What kind of like capital gains tax where it's your primary home now do you have to go through if you do end up selling and moving somewhere else? If you do sell, you don't get the same primary residence exclusion like you normally do. Normally, there's a code, section 453 of the code. It's called the primary residence exclusion. That
says if you live and own a house for 2 out of 5 years, you get $250,000 tax-free if you're single, $500,000 tax-free if you're married. That doesn't apply if you bought the property through a 1031. So what your tax person would do is basically say, how long, what percentage of time did you own that property as your primary? And it's not just that specific property. It goes back to the whole chain of when you did an exchange and you sold it and you bought a new one. So they're going to look at the whole gamut and they're going to say, okay, you lived in the property 20% of the time. And then the rest of the time it was a rental, the one in Boca plus the one that you originally sold. So 20% of the time it was your primary. So you'll be able to defer taxes, or excuse me, you'll be able to eliminate taxes on 20% of the tax. The other 80% of the time, it was a rental. So you've got to pay tax on that portion. So it's pro rata. You don't just get it all for free.
Okay. So in that case, you pay taxes on the purchase and sale of the property, and then you pay income tax on the rental income that you get.
Well, of course you do. Yeah.
All the taxes.
They get you many ways. So like I said, it's always good when we can find a way to defer tax, like I said, through the 1031.
Yeah, absolutely. Okay. That makes sense.
All right. So yeah, I guess a question came up about being a second residence. Yeah, your second home doesn't qualify for 1031 either. It's got to be rental property. You know, you've got to rent it out.
Because my second home right now is actually an Airbnb. I've never lived in it. It's been rented out.
Okay, so how long have you had that property?
2 years.
Okay, so you've Airbnb'd it for those 2 years, excuse me?
Mm-hmm.
Yeah, and as long as you're reporting it on your taxes, that is now an investment property. So yeah, if you decided to sell that property, you could do a 1031 exchange.
Okay.
It doesn't have to be a long-term rental. A short-term rental, as long as you're not using the property personally, is still an investment, so it still would qualify under 1031.
Sounds good.
All right.
Thank you.
Sure. Moving on a little bit. There we go. The property has to be in the U.S., so you can't exchange the Washington Monument for the Eiffel Tower. Yeah, sorry about that. But you can exchange any place in the U.S. So like I said, you sell a property here, buy a property in Boca or wherever, as long as it stays in the U.S., it does qualify for 1031 exchange treatment. And there are some financial requirements a taxpayer has to meet to defer their taxes. To defer all taxes, they have to do 2 things. They have to reinvest all their proceeds from their sale as down payment on the property they're buying. And if they have debt on the property they're selling, they've got to get new debt on the property they're buying equal or greater amount. So how that looks is this. We're going to sell this $1 million property you see on your screen. We have a loan of $400,000 at the closing, and we're going to net around $550,000. Now you'll notice my math is bad because we should net $600,000. Well, we won't because we're going to have closing costs, commissions, title insurance, escrow fees. Mm-hmm. So any seller is not going to net $600,000. I'm just saying we're going to net $550,000. Before that sale ever closes, the taxpayer must hire a qualified intermediary. That's what we are, a Security First Exchange. We're a qualified intermediary for 1031 exchanges. Because what we do is we document the transaction in case the IRS ever audits. And the other main thing is we hold the money. So the taxpayer, the seller, can't receive that $550,000. If they touch it, it's taxable. So that's one of our jobs. Hold the money until we're ready to close on the purchase. So when we're ready to close on the purchase, we transfer in the $550,000. The client will get a new loan for $400,000 and they'll defer their taxes. There's no boot, no taxable liability because they met the financial requirements. They spent all the cash, they got a new loan, equal or greater value. That's what you have to do to be able to defer your taxes in a 1031. An example of someone not doing it right, the client, again, they sell that same property, but this time they say, well, I don't want to put all the money down. I only want to put $400,000 down because I want the other $150,000 for myself. Can you do that? Sure, you can, but that's called cash boot, meaning you've got a liability, a tax liability, and the tax liability is on that $150,000. So in this example you see on the screen, this taxpayer is going to pay tax on $150,000 because they didn't spend all the money in the 1031 exchange on the new property.
So they do get that cash back though.
Yeah, what we would do when the exchange is over, we'd give them the 150 back, and then it's up for them and their tax person to go ahead and claim that on their taxes in the next tax year.
Okay, but like here, the equity is 550. I can't just go buy a property that's 550 and pay cash for it. I have to get a loan.
That's a great example. So now you can see that on the screen.
Perfect.
You can't just buy that property because the IRS says you also have to reacquire the debt.
Mm-hmm.
So in that example, like you just brought up and we see on the screen, the taxpayer is buying, they sold a property for $1 million and they're buying a property that's much less value. That is taking value of real estate out of the economy. They want the economy to grow. Mm-hmm. And it's not going to grow if everybody just takes their money and buys something else. So in this example, they have, again, what's called a boot, a tax liability, but it's on the mortgage because they didn't reacquire a new loan. So they here in this example, even though they spend all $550,000 as down payment on the property they're buying, they would still end up paying tax on the $400,000 that they did not reacquire in debt. So a lot of people get confused about 1031 about that. So again, a reason that a taxpayer really needs to consult with their tax professional as they're doing it to figure out what the numbers are going to look like, what they have to do. We can tell you as a qualified intermediary, but I don't know the exact numbers in your transaction. That's where your tax person is going to play a huge role in the exchange.
Okay, that makes sense. So like we're giving you a break from paying your taxes now, but you have to keep the same amount of volume of property in the economy to keep on going. That's
exactly, yeah.
Basically is that trade. Okay.
Yep, and that's exactly it. Any less, you're going to pay tax on the difference.
Okay.
Yep. Now, there's one other thing taxpayers need to know about a 1031 exchange, and that's the time frames. You have specific time frames to get things done for a 1031 exchange. So I want to show this on a timeline. Day 0 of an exchange is a day of closing. So that's when you transfer ownership seller to buyer. Day 0, closing. Now, before that ever happens, you have to hire a qualified intermediary. You can never call us after the fact. Well, you can call us, but we can't get it set up for you. Mm-hmm. Unfortunately, I get that call pretty regularly. I want to say about 30 Mondays out of the year, we have this message on our machine or this email that comes in, and people are saying, hey, I want to do a 1031 exchange. We closed our sale on Friday, but I still want to do it. Over the weekend, I learned about an exchange and this sounds great. I want to do it. And we have to break the bad news to them that they can't. Mm-hmm. Because once the sale closes, the money is due to the seller. The money can never be due to the seller in a 1031 exchange. It has to be due to us. So in our documentation, it's specified that the title company can't transfer the money to the seller. They have to transfer it to us to be able to hold for the 1031 exchange. So we're going to make sure everything's done right. But again, it's got to be done before that sale closes. So you always need to call us before your sale closes, whether that's, I would love it if it was maybe a week or two before closing to be able to get all the documents coordinated with your title company. And, so it's not a fire drill, but it's very regular. We get a call the day before the closing, even the day of closing. As long as the transaction hasn't closed yet, we can get it done. It's just a little bit of a fire drill. So don't think you can't. But we'd like a little more time than that, just so not to rush anybody. So let's say you did that. You got everything ready. Day 0 is day of closing. Day 1 is the day after closing. A taxpayer has 45 calendar days to identify with the qualified intermediary exactly what they're going to buy. So you have to know what you're going to buy in the 45 days, and not just generically, house in Boca Raton. No, you've got to have specific property address, city, state. You have to know exactly what you're going to buy in 45 days. And you have to close on it within 180 calendar days. So those are the time frames.
I told you right there. Are you familiar at all with how our market is? Mm-hmm. Because it's very hard for us as agents to identify, I think you said 3 properties?
Well, you can identify up to 3.
Up to
Uh,
3.
right.
But like the maximum is 3.
There's another rule we'll talk about in a second where you could actually identify more, but it's a different scenario. But let's make the let's just make the understanding that you have a client that's selling one property and they just want to buy one a little bit bigger. Yeah, they only have 45 days to find it, and it can be a challenge. Imagine a year ago, though, before January, February of 2022, the market was just through the roof.
Mm-hmm.
At least now it's gotten a little more level between buyers and sellers. Before it was a total seller's market. Now it's a more even. It's easier to find property. A year ago, it was miserable. Clients were still doing it though.
What happens if I identify 3 properties and we've tried to submit offers on them, and I had already submitted this to you because we were getting really close to that 45-day mark, and then we didn't get any of our offers accepted, and then obviously day 46, because my luck, we find and go under contract on a property. That's it, we're done. There's no way around that.
There's no way around it.
That's harsh.
Yeah, remember, not my rules, it's the IRS rules. I'm just a messenger. But what has to happen is the client has to send in an identification form. Every qualified intermediary, it's a little bit different, but it's basically the same. Using the 3 property rule, you can identify up to 3 properties, and you don't have to identify 3, because if you have 1 property under contract and it's great, then you can just identify 1. But once the 45 days expires, we can only help you purchase what's on this list, nothing else. So if you just have 1 property on there and it falls out for any reason and we're past the 45 days, yeah, you're stuck. You will end up paying your taxes. Done. No way around it. So we always recommend trying to identify an extra property or 2 extra properties. That way you've got backups in case something goes wrong with the first one. Again,
Okay.
it's not the ideal, but I'll tell you this. Since 2006, I've been able to track this in my offices. The lowest percentage of clients being able to identify and close on property, and this has all been on a yearly basis, from 2006 to 2022, the lowest percentage any year of people completing exchanges in my operations, 93%, and it was at a high of 97.
Okay.
And that was in 2016. I had 97%. So it's never been below 90% where clients can't find property. 93 to 97% always identified property in the 45 days and closed on it within 180.
Okay. So no pressure, but we got this.
Yeah, yes, it sounds bad, and I don't disagree, but most of the time we can get it done.
Okay. So on the other aspect of this, you said we have 180 days. That's 6 months to close.
Correct.
What if for any crazy reason we are not able to close within that time frame for circumstances that are beyond our means, like a bank or a lender or foreclosure or something like that? What happens then?
What do you think? I'm gonna talk.
I don't want you to tell me what I think you're gonna say. That's what I think.
I know you know what I'm gonna say. The IRS doesn't care. You have 180 days. That's it.
But it's not our fault.
Again, the IRS doesn't care.
Well, darn it.
Yeah, I wish I had better answers. There have been rulings. There have been people trying to, get extensions. I had a client, 10, 12 years ago, a husband and wife. The husband passed away within the 45 days. And no one reached out to us. No one told us. And part of the reason was the wife didn't even know they were doing an exchange.
Oh, wow.
By the time she found out, we were calling, we were emailing, no response. She reached out to me, I want to say by day 60, something like that. And she said, I just found out we were doing this exchange. And I said, yeah, and you didn't identify, so there's nothing we can do.
Mm-hmm.
And she said, well, my tax person says we should try to get what's called a private letter ruling from the IRS. Basically pay them to make a case for this to see what they could do.
Mhm.
They wrote a $9,000 check, because that's what it used to cost back then, and sent it to the IRS with their claim. 2 weeks later, she got that $9,000 check back with a letter saying, we will not even look at this. You had a bad exchange. You have to pay your taxes.
Oh, wow.
They wouldn't even consider anything with that.
That's crazy.
That's how harsh the IRS is with it.
That's crazy.
Yeah.
It is what it is then. So we just have to like be very, very aware of that time, that clock that's ticking basically day after day. And there's no way to operate otherwise.
Yep. I do see a couple other questions that came in, so I'll go ahead and ask really quick, or answer them really quick. What are the average fees for a 1031? You know, it varies by the 1031 exchange company. Our fees, any transaction under $1 million is $850. And that covers everything for the sale and for one purchase. So you sell that property for $500,000, $850 covers everything. If it's more than $1 million, it ticks up a little bit just because liabilities, as the liability goes up, the fee costs more. $1 million to $3 million is $1,095. $3 to $5 million is $1,295. Little things like that. We are a little below average out there. You're going to find the average exchange is somewhere around $1,000 for that under $1 million exchange. And again, ticks up a little bit as it get bigger. So like I said, we're just a little bit under, but that's the kind of the way the industry works, shall we say.
So when you say under $1 million, you mean the actual equity that you guys are holding on to, the taxable money, or the actual property value?
Sales price.
Sales price. Okay.
So yeah, if you sell a property for $750, but you only net 200,000, well, I should go a different way. If you sell a property for $1.2 million, but you only net $500,000, we still charge you based off the $1.2 million, because the liability of the transaction is based off the sales price, not the cash coming into the transaction.
Okay.
So there's another question I saw. Can I buy the new property before selling the old one and still do a 1031 if the two transactions are still within 180 days? No, unfortunately, because you need the cash from the sale to be able to use the purchase. You can't just like front your own cash and then get paid back. You've got to have that cash from your sale be used as down payment on the property you're buying. So you really want to make sure that sale is going to close first, so that the money will come to us as the QI, and then we use that money as down payment on the new property after the closing. Now, we don't have to hold the money forever. If you sell a property and it closes today, we'll probably get the money tomorrow, because we normally get it the next business day after the closing. We could close your purchase the next business day. We can close them right away. You don't have to wait the 45 days or 180 to close. We can close your purchase as soon as we get the money from the sale.
Okay, so it could be like a contingency situation where it's under contract, but the new property is under contract, but the old one has to close first, and then the new one can close the next day or within that 6-month period.
We see that a lot. People making contingent, and they say, you know, as soon as this sale closes, we're going to close on the purchase, and that's fine.
And that's so much easier because now you already identified the property because it's literally under contract.
Yeah, in the industry, we actually call it a slam dunk, because you close the sale and the purchase is going to happen right away.
Yeah. Okay. So under contract, yes. Closing, no.
Yeah.
Got it. Sounds
right.
good.
I know I've been talking a lot, but we're getting close to wrapping up. If anybody else has any questions, go ahead and, like I said, type them in under the chat. Again, no extensions to the 45 or 180 days. You have to make sure that you identify that property in the 45, close within 180, spend all the cash as down payment. Don't forget the debt. Make sure that if you had debt in the sale, you get that same amount of debt or more on the purchase. And most people, they're not forgetting that. Normally they're buying more. Mm-hmm. You know, normally if you sold a property, and again, I'm not using the same numbers we did in the example, but if you sold a house for $400,000, normally you're buying something bigger, or you're leveraging. Can you sell one and buy two? Yeah, sure you can. It's a great thing in the market too, because now you got more income, more deductions because you have more properties. So that all works. Again, as you still just have to spend all that money. So if you have that, whatever the dollar amount is that you netted from the sale, you could divide it up and put half down on 2 properties, however you want to do it. But at the end of the day, did you spend all the cash? Did you reacquire debt equal or greater? Even in multiple properties, as long as you did, you defer your taxes.
So I have another question.
Sure.
Let's say I was not able to identify a property in 45 days, or I did and I can no longer go through with that contract. How soon do I get my money so I can pay taxes on it?
Great question. If you don't identify property within the 45 days, I can give you your money back on day 46 because you didn't identify anything. Your exchange is over. You can get your money back. But if you do identify property in the 45 days, but then you decide or you can't purchase it, the IRS says you identified property. You said you were going to buy something. The QI has to hold the money until the 180 days is over. And then when the 180 days expires, we give you back the money and you pay taxes.
So no property and no money for 6 months. You're holding hostage for the whole entire time.
Only because I have to. It's not, I don't want to do it, but the regs are very clear. And every once in a while, I have an attorney call for the client and say, hey, this doesn't make sense. I'll send them a copy of the regs and they'll say, okay, there it is in the regulations. I get it.
Yeah.
It is what it is.
Okay. So that's another thing that people should take into consideration when identifying properties. It sounds like your slam dunk situation is identify a property that you already have under contract is the best way to go. If you identify it and it doesn't go through, then just keep in mind that your money will be held back for the entire 6-month period. You can't use it for anything else. And
I didn't mention one thing. You can re-identify within the 45 days. So if you identified on day 20, and then you found and then the property you did an inspection, there was something you didn't like, you can submit a new identification inside the 45 days. It's only after the 45 days that you're stuck.
Okay, well, that's a little helpful, a little bit, not too much.
Not much,
a little. So we have one more question. Can you combine multiple sales of a 1031 to one bigger purchase?
Yeah, definitely. So if you sell 2 $300,000 properties, you could definitely go buy one bigger property. So, but remember this, if you sell 2 $300,000 properties and you're just going to combine it into one, you basically have to buy a new property that's equal or greater in value. Now it's not just based on one, it's based on 2. So in that example, you'd have to buy a property that's at least 600,000 or greater, the sum total of the 2 you sold. And then the other thing is the time frames. We talk about the time frames for the 1031. It's all going to start upon the sale of the first one. So your first sale closes today. Your second sale isn't going to close for, let's just say 30 days. But your 45 and 180 days are all going to be based off the first sale that closed today. So you have to keep that in mind. It's 45 days from today and 180 days from today.
Okay. Well, you're going to make us go scramble and find a property anyway, so I don't see a problem with that. I have one more question.
Please.
So we were talking about the like kind stuff. What if I had a single family home and I ended up wanting to participate in a multifamily syndication for an apartment complex?
Okay.
Does that work?
No. In a 1031 exchange, you have to take title to the property. And normally in a syndication, what you're going to do is you're going to contribute your money to become a member of the LLC or the partnership that is putting that syndication together. That doesn't work because you're not taking title. You have to be on title on the property you're selling, and you have to be on title the same way on the property you're buying. So
if you were on title, it works.
Yeah, if you were going to take a tenant in common interest in that property, it could work. Yes. Okay,
because we have something like that going on right now, and I was told by the commercial exchange that I went through that there's specific forms that need to be filled out for that to work. But like it was like a very rare, like if this works out, then you can do it this way, but it also is going to cost thousands of dollars of legal fees. So, but it does work in very specific ways.
Yeah, I would want to, if something like that were to come up, I would want to look at it and see what's going on, because like you said, it's a little complicated. It's very specific. Normally, it doesn't work. But like I said, in some instances, maybe it could if it's being structured properly.
Okay. We have another question. Are the funds held in an interest-bearing account? And if so, where is that interest from that account going?
Sure. So that I can tell you, I'll tell you for us how we do it at Security First Exchange, and I'll let you know what is kind of behind the scenes in the industry. We and many qualified intermediaries out there will deposit money in segregated accounts. So if I have 1,000 clients right now, I have 1,000 accounts at the bank set up for each client with their name and their tax identification number on that account. What that does is it lets the client, first off, get the FDIC insurance. They will get the insurance because it's their name and tax ID on the account. Mm-hmm. And also, since it is a segregated account under my client's name, yes, they will earn all the interest on that account. That's how we do it at Security First. That's how a lot of people do it, but I won't say every qualified intermediary. I know for a fact, not every QI does it that way. Some will set up commingled accounts because it's pretty expensive and complicated to set up these segregated accounts for every client. So there are some smaller QIs out there that just set up like if I had my own company, Carmine's Exchange Company, I will set up an account at the bank under Carmine's Exchange Company. And then if I have 100 clients, I will put all their money in that account. That they're not going to get the insurance. They're not going to get the FDIC because it's all under my name and my business tax ID. So you need to ask that specific question anytime you deal with a QI to see how they do it. But again, how we do it, yes, we set it up segregated accounts because that's best for you, because you're going to get all the benefit. And that's not why we're here. We're here to do the exchange, and we want to make sure it's as secure as possible. And those segregated accounts is the best way to do it. So always ask a QI, how are they depositing? And who are they depositing with? The bank is just as important. Mm-hmm. Again, I'll volunteer. We use Capital One Bank. They're a great bank for qualified intermediaries because we can do everything online. You can only imagine how many 1031 exchanges we might have. So we've got to set up those accounts. We can do it all online within a couple of minutes. So money comes in, I can have your segregated account set up in minutes. And then if we're wiring money out, it's not uncommon that we need to be able to close your account at a moment's notice. We can do that online very easily. That's why we use, and there are a lot of banks that do it that way that we could select. We liked Capital One because of, again, how they were able to structure it. But there are other banks that work like that for qualified intermediaries, but there aren't that many. There's only maybe 10 to 15 banks that really have a good structure for qualified intermediaries. But again, that's why we use them. We use them to keep your funds secure.
Okay, and that percentage that is accrued, every QI would tell you in their forms and documents what that looks like, or how does that work?
Our documents just say you earn all the interest, because the interest varies. So, we see interest rates change. You earn all the interest. I mean, that's just what we say, because it doesn't matter whether it's, whatever percentage it is, it all goes to the client. Now, don't expect great interest from any QI. Why? Because the banks know our business. What is our business? We're going to hold the money, not for long. The longest we could ever hold your money is 180 days. That's the longest. What's the shortest? A day or two. It's not uncommon, like we talked about a couple of minutes ago. I get your money today and I wire it out tomorrow. The banks know this. They know what the average exchange lasts. So they're not incentivized to pay a lot of interest to our clients because they know it's not going to be there that long. Right. So they don't pay great interest, but that's not why you're doing an exchange anyway. You're doing an exchange to make sure the money's secure while it's there. And basically you want to go buy something else as soon as possible. So, don't expect 5% interest. Not going to happen.
Then we wouldn't need another property. We'd just leave it with you.
Great point.
Sounds good.
All right. Well, I am actually wrapped up. If we have anything, there we go. If we have any other questions.
I think this has been really informative. Maybe one question would be, why would someone not do this? Like, we were talking about pros and pros and pros. What is one of the biggest cons of why someone shouldn't do this, or if it's not good for them?
Well, first reason is you don't want to buy more property. At some point, most older clients will say, I don't want to have any properties anymore. I don't want to manage. I don't want to worry about it. I want to get out of the real estate market. Don't do an exchange, because the 1031 makes you buy new property. There are some situations where you might even say, all right, I have other debts, I have other liabilities, and I just need to erase those. 1031 doesn't work for everybody. It doesn't make sense for everybody. Or when we talked about those financial requirements, I will jump back really quick. When we talked about those financial requirements, we talked about the mortgage boot. So I said you had to spend all the cash and get a new loan of equal or greater value. Mm-hmm. What if you can't qualify for a loan? Mm-hmm. What if you're not going to be able to get a loan for $400,000 in this example? Then you're going to have a failed exchange anyway, and you're going to pay your tax. So knowing what you're getting into and knowing what the requirements are, one thing would be, all right, talk to a lender before you do anything and say, I'm going to have a $400,000 payoff. Am I going to be able to get a new loan for $400,000 to meet the 1031 requirements? Maybe you're not. Maybe you're retired and you only have a little income coming in. Maybe you're not going to qualify. So there are a lot of things you have to talk about and analyze, again, with your tax person and, again, lender, to make sure that the 1031 makes sense for you.
And here on this slide, when we say loan, that is the balance on the loan at the time of closing, right? That is not the original loan that we had when we started. Okay.
Correct.
Okay.
Well, and so you could pull this number right from the settlement statement.
Yeah. Okay. That's the payoff amount.
Yep. Cool.
Well, I don't think we have any more questions, so I wanted to go ahead and thank you so much for joining us tonight.
Thank you.
But this was very informative. Don't take any offense in me telling you you're holding my money hostage, but we have to make IRS talk a little lighthearted. So appreciate it so much. And this is your contact info. So if anybody wants to reach out to you directly with any more questions, please reach out, scan his QR code, or write down his email, phone number, all of the good stuff. But yeah, other than that, I just wanted to wrap up and say thank you so much for joining us.
Thanks, everybody.
Thank you. Well, that brings us to the end of another episode of Keeping It Real. We hope you enjoyed our conversation today and gained some valuable insights into the world of real estate.
We'd like to extend a big thank you to our guests today for sharing their expertise and experience with us. We are grateful for their time and their insights.
If you have any questions or comments or want to be a guest, feel free to reach out to us on social media or via email. We always love hearing from our listeners and value your feedback.
Don't forget to tune in next week for another exciting episode of Keeping It Real.
We will be featuring another expert guest and diving into a new topic related to the world of real estate.
Until then,